Guys, we are going to discuss today. This topic is called income tax. This is what topic we are going to discuss. And in income tax, we will talk about something which is called deferred tax also. So let me just give you simple overview. Like usually when we prepare income statement, so in income statement, obviously we write sales, less cost of goods sold, right? So then you will arrive at gross profit. From there, you deduct certain expenses. So you would reach at profit before interest and tax. Then you deduct from there what? Interest expense. This is called what? Profit before tax. From there, you deduct then which expense? Tax expense. This is called what? Profit after tax or net income. Actually, this tax expense, how it is written, this is what we are going to discuss, or how it is calculated. Understood? So this tax expense, which you would see in your income statement, how it is calculated. Usually we say we'll take profit before tax and multiply by tax rate, so you will get what? Income tax. Actually, this is not the scenario. So now I'm going to work with first how you would get this tax expense in your income statement. So for that, I have here small format. So here we go, starting from here. So income tax expense or benefit in income statement, how it is calculated. So here it is one concise format. So what we do, we always take under tax expense, we always take two things. Number one, what we take? We always take current year tax expense. What? Current year tax expense for this year. And then we have something else here that is called what? Plus minus. We will do plus minus in the current year tax expense. We will plus minus what? Deferred tax expense or benefit. So this is another word. It means there are two words. So in tax expense, we have two things. Which two things? We have a current year tax expense. And then we have what? Second word is what? Deferred tax we have inside. What is deferred tax? That I'll explain gradually, but just I'm working with the format only. So deferred tax, I'll explain definition later. Just focus with you what I'm explaining now. So first here we go, how to calculate current year tax expense. How? How it is calculated current year tax expense. So first of all, for current year tax expense, we always take what? We always take what? Taxable income. Which income? Taxable income. Okay, actually this taxable income is not the straightaway income which you will take from the income statement. No. This is the taxable income. And how it is calculated, let me tell you here. So I'll just give you brief overview about taxable income, how it is calculated. And actually what we do, we always take for the taxable income, we always take, profit before tax. This profit before tax from where we take from the income statement. And then we adjust this profit as per tax law, as per tax law. So what we will do, we will do some plus or minus of certain expenses or income as per tax law. So it means here we will do some which adjustment? Tax adjustment which belongs to expenses or income are what? Both. So then what we will get profit, we will get what? Taxable income. So please remember, I'm saying one more time what it is. Then we'll continue. How taxable income is calculated? We always take what? Profit before tax. And then we will adjust this profit before tax as per tax adjustments. What I said, we will take profit before tax from where we will take from income statement, and that profit we will adjust. I need concentration. We will adjust as per tax law. Now, why we need to adjust? I'll give you a couple of examples, but with the topic here, I can just give you a few number of examples I can quote here. For example, there could be a certain expenses. which we are writing under accounting income, under income statement, but those expenses are not allowed under tax law. For example, one example is what? Depreciation. The accounting depreciation is not allowed by tax law. So, but in income statement accounting depreciation, we have already deducted, right? Because that is not allowed. So what we will do? We will add back, right? Because from tax point of view, accounting depreciation is not allowed. There is a capital allowance which is called tax depreciation that is allowed. Now you are maybe thinking, what's the difference between accounting depreciation and tax depreciation? Accounting depreciation means which is calculated by accountant's judgment. You are using your own judgment. But tax depreciation you will calculate always by using tax rules. Understood? So that this is how we will adjust our profit before tax to the taxable income, or we will adjust our accounting profit, okay, to the taxable income. That I'll show you, don't worry. This is just my starting point. So first I told you here, simple first point I told you, how you will calculate current year tax expense. You always need what? Taxable income, which you have to adjust. Which income you have to adjust? Accounting income you have to adjust as per tax law. So then you will get taxable income, and that taxable income you will multiply with what? You will multiply with the enacted tax law. Tax law means enacted tax rate, whatever current tax rate is there. So if you will take, so far remember only one thing, taxable income. We need adjusted taxable income, tax adjusted taxable income, multiply by what? Tax rate. You will get what? You will get one value, and this value is called what? Current year tax expense. Understood? So I'll explain in more detail, but with the passage of time. Then what I told you, with the current year tax expense, what you have to do? So you will add here what? Plus minus what? Deferred tax expense. Deferred tax expense. I'll explain the definition of deferred tax also here, but I'm working with only format. With the passage of time, I'll tell you what is the deferred tax, why it is arising. So here, deferred tax expense, how you will calculate? Because under deferred tax, you may have two types of things. You may have deferred tax liability. What? Deferred tax liability. Or you may have what? Deferred tax assets. So here we go. I'm reading one more time, and then I'll take you to the format first. So what's written here? So with the current year tax expense, you will always add what? Deferred tax expense. And deferred tax expense is what? You need what? You need net changes during the year in deferred tax amounts. So it means there, and then I told you what? Deferred tax has two types of amounts. It may have what? Deferred tax liability. It may have what? Deferred tax assets. So we need net changes in deferred tax liability, and we need net changes in deferred tax assets. The problem is that how you would work with the net changes. How you will work with the net changes in deferred tax liability and deferred tax assets. So please remember here, guys, this is how you will calculate. Calculation I'll show you, just I'm working with the format. For example, if you are dealing with the deferred tax liability, definitions I didn't explain, I'll explain it. So if you're dealing with the deferred tax liability, how you will get net changes in deferred tax liability? So you will always compare two values. Which two values? What value you have as opening deferred tax liability? Opening balance. Opening balance is what? At the start of the year. And then, so you also need to work with what? Closing balance of deferred tax liability. Now tell me, for example, if opening balance is $1,000 of deferred tax liability and closing balance is 1,500, tell me deferred tax liability has increased or decreased? It has increased, right? It is increased by how much? 500. So it has increased, but it may decrease also. It may increase or it may decrease. It means this is the net change in deferred tax liability. It is increased by 500. Then same way you have to work with what? With the deferred tax asset. So what you will do, how you will get net changes into that? So you need, I need concentration here. You need opening balance of deferred tax asset, and you need what? Closing balance of deferred tax asset. So for example, opening balance is, let's assume 10,000. Closing balance is 18,000. Tell me deferred tax asset has increased or decreased? It has increased by how much? 8,000, and it may decrease also. This is what is called net changes. This is called what? Net changes. Okay, I have a quick question from you. I have a quick question from you. Just I'm asking, checking your mind here. So what is the increase in liability? And what is the increase in asset? Can you tell me what is the net change in deferred tax? Net change is how much? 7,500. This is deferred tax asset or liability? Why? Because asset value is more. So that's why it means this net change is 7,500, which is what? Deferred tax asset. Understood? Now here we go. Let me tell you here. Now just I'm going to work with the double entries first. What entries are there? Then we are moving to the concept side. Understood? So what I told you, in current year tax expense, there will be two things. Which two things? There will be two things. Which two things? Under current tax expense, you will have a current year tax plus minus what? Deferred tax expense. And under deferred tax expense, you may have deferred tax liability. You need to work with deferred tax liability. It has increased or decreased. You need to work with the deferred tax asset. It has increased or decreased. And then you need to find a change, right or wrong. And that change you will adjust with what? With the current year tax. So this will give you what? Income tax expense in the income statement. Understood? Now here we go. Please, I need concentration here. This sheet I will share with you. You can take it, guys. So here, please focus with me. Now let's understand first entries, and then I'll work with one small example just to clear the format, like format is clear or not. So here we go. So let's assume if you know what is your current income tax expense, current year. For example, it is 1,000 or 2,000. What entry you will pass? So you will always debit what? Income tax expense, and you will always credit what? Income tax payable. For the current year, what entry you will pass? Tax expense debit and tax payable credit. Right or wrong? Now you are working with what? You are working with the deferred tax liability. If deferred tax liability has increased, has what? Increased. So with increase, tell me whenever liability is increasing, liability is credit or debit? Liability is always credit. Then what will be the debit? Debit will be what? Income tax expense. If you know one side, right or wrong, second side will go to income tax expense. Here you know if liability has increased, so credit should go to deferred tax liability. Right or wrong? So then what should be the debit? Income tax expense. Right or wrong? It means whenever liability increases, tax expense also increases. Agreed or not? Right or wrong? Because expense is debit. And whenever deferred tax liability what? Decreased. Whenever it is decreased. So what entry you will pass? Whenever liability decreased, you should debit deferred tax liability. If you know the debit side, what should be the credit? Credit should be what? Income tax expense. Same way, when you are dealing with the deferred tax asset, first you need to calculate what is the increase or decrease in deferred tax asset balances. If deferred tax asset has increased, whenever asset has increased, it is debit or credit? It is debit. So deferred tax asset will be debit. Then what will be credit? Income tax expense will be credit. It means whenever that there is increase in deferred tax asset, tax expense will decrease. And then if the deferred tax asset decreases, so when asset decreases, so asset should be credit. Deferred tax asset should be credit. Then what will go to debit side? To debit side, it will go to what? Income tax expense. Can we create one small equation now? If we can create equation by using this entry. So for example, now I'm telling you here, this summary is very fruitful. So you can work with this summary also. It will make your life easy whenever you are working with the tax expense for the income statement. Always take first current year tax expense. Current year tax expense, I told you, you need taxable income multiplied by tax rate. Take that value. I'm assuming here you have a taxable income, not taxable loss. Understood? So we'll take what? Current year tax expense. Understood? You will take that value. Then what you will do? You will plus here what? Increase in deferred tax liability. Do you remember whenever deferred tax liability increases, what was the entry? Liability was credit. So debit was what? Expense. So expense will be added here, right? Because this is what expense account we are dealing, right? So it will be added here. or because there will be one scenario, either deferred tax asset will increase, sorry, deferred tax liability will increase or it will decrease. If deferred tax liability is decreasing, so you have to what? Decrease in deferred tax liability. So what you will do? You will deduct. Why you deduct, sir? Because liability is debit here, credit will be tax expense. So expense is reducing. So same here. So if you are, this is what, this is the section for what? Deferred tax liability. This format I'm showing you as a student. You should remember this format while tackling the question. And now I'm going to deal with what? Deferred tax asset. So again, there could be two scenarios. If there is a increase in deferred tax asset, deferred tax asset. What was the entry? Debit was deferred tax asset. So what was credit? Tax expense. So that will increase in deferred tax asset. You will deduct. It will reduce your expenses. And whenever there is a decrease in deferred tax asset. So what was the entry when there is a decrease? Deferred tax asset was credit. Credit because decrease. Asset should be credit. What should be debit? Expense. Expense is debit, so that's why it will be added with the expense. So this is how, if you will add all these five things plus minus, so this is how you will get what? You will get income tax expense where for what? Income statement which you will deduct from profit before tax value to arrive at net income. Understood? Format is clear in your mind? So for what I told you, I didn't explain even what is deferred tax. I'll explain now, but I'm just working with the format. In format, what you need? This thing you need to memorize, this thing. What is written on your screen now? Is that clear? So here we go. Let's do first with the help of example. Just practice for this format. Then we'll open one by one item and we'll discuss it how to find out. So here we go. For example, we have here Lucas company had the following deferred tax balances for the year just ended. Understood? So the deferred tax asset is fully realizable. Realizable means that you can claim it. Understood? Then they're saying the company's taxable income is how much? 1 million for the year. This is taxable income, current year. Then they tell you enacted tax rate is 40%. This is which rate? Tax rate is 40%. And then they're telling you here beginning balance, ending balance of what? Deferred tax assets and deferred tax liability. Please make one note. You will be provided with the beginning balances in the most of the questions. You will be provided for sure. Only you need to work. If you will, we will calculate. We will learn how to calculate ending balances. Beginning balances will be given. Ending balances you have to work how to calculate that I'll show you later. But here just we are dealing with the format. So tell me now, deferred tax asset has increased or decreased? Because opening was how much? 9,000. Closing is how much? 17. It is increased by 8,000. What about deferred tax liability? Opening was 13, closing is 23. It is increased by 10,000. Okay, now just I'm asking question. Then I'll tell you entry. Can you just complete the format? For this is deferred tax asset, this is liability. Now tell me format. What was the format? You will take what? Current year tax. Current year tax, how you will take? You will take taxable income, which is 1 million multiplied by 40%. So this will give you how much? 400,000. Now tell me, deferred tax asset has increased or decreased? Whenever deferred tax asset has increased, you will deduct. Right or wrong? So increase in deferred tax asset by how much? 8,000 you will deduct. Why we deduct? Because deferred tax asset has increased. It means the asset was debit and tax expense was credit. Now look at here. Here deferred tax liability has increased by how much? Has increased by 10,000. 10,000 is 10,000. So what you will do whenever deferred tax liability is increasing? So we will add the reason because liability will be credit because it has increased. Debit will go to expense. So that is why the expense is increasing, right? So we will add an increase in deferred tax liability. By how much, guys? By 10,000. If you will do plus minus, so this is going to be your income tax expense. income tax expense for the income statement, which is going to be 402,000. Now I'm just asking one simple question. Opening balances of deferred tax assets and liability will be given or not? Will be given. And which balances you have to work? Only ending balances. And then you can find increase or decrease. How you find increase or decrease? You have to do the opening balance with the closing balance. You will find what it has increased or decreased. According to that, you will deal with the tax expense. Can we pass the entry now? Okay, this is what tax expense we calculated. I just want you to practice double entries also. So how entry you will pass? First of all, see, look, values we know. Current year tax is 400,000, right? So what was the entry for current year tax? We always debit income tax expense by 4,000 and income tax payable by 4,000. This is clear? Right or wrong? Now tell me, deferred tax asset has increased or decreased? In the example, deferred tax asset has increased by 8,000. It means I will debit now deferred tax assets by 8,000. This amount is also covered now, right? Now tell me, what about deferred tax liability? It has increased or decreased? Increased. So deferred tax liability will be credited by 10,000. So see, right or wrong? I'm passing one combined entry. Now see, you have credit, two things on credit, two things on debit. Right or wrong? So if you will, now you will look the balancing amount in the entry. The balancing amount is how much? 2,000. This 2,000 will go to what? Income tax expense automatically. Now if you will look, what is your income tax expense? Tell me your income tax expense. If difference is on debit side, obviously this will be added to the tax expense now. So income tax expense is what? 4,000 was for current year. This is the net. 2,000 is for net changes in deferred tax assets and liability. How? Look at here. Asset is increased by 10,000. Liability is increased by, sorry, asset is increased by 8,000. Liability is increased by 10. So it means what is your net answer? 2,000. 2,000 of liability. 2,000 of, whenever net liability is there, so tax expense will be debit, liability should be credited by entry if you are passing separate entry. So that's what this is added with the tax expense. And by the way, here we got as a balancing value in the entry. Understood? So if difference is on debit side, it will go to income tax expense. It means debit income tax expense means it will be added with the tax expense. If difference is on credit side, it may come on credit side. It means it must be deducted from current year tax expense. Understood? This was the only format. Literally, I didn't tell you anything, and we spent maybe 20 minutes on this. It is just the format. Now let's have a look. I'm going to tell you here. Again, I'm just repeating one more time format. The reason I'll tell you later. So what is the reason here? So whenever you calculate tax expense for your income statement, you always need what? Current year tax expense. How you will work? You need taxable income multiplied by tax. And then you need what? Plus minus changes in deferred tax. And there could be a deferred tax liability and there could be a deferred tax asset. First, we need to work increase or decrease in deferred tax asset. Then we need to work increase or decrease in deferred tax liability, and accordingly we will plus minus. I told you equation also. Understood? Is that clear? Okay, and then I told you this one story here because now we are moving to the conceptual side. I told you this, when you calculate current year tax expense, you always need what? Taxable income. This taxable income is accounting income or it is adjusted as per tax law? Give me the answer. It is adjusted as per tax law. And how it is adjusted? You always take GAAP income. GAAP means you always take profit before tax. From where? From the income statement. And then you do plus or minus. Plus or minus what? Differences between accounting rules and tax rules. Those things you adjust. So this is how you will get what? Taxable income. And now I'm moving to the main side. I need concentration. So please remember here, and then I'll explain other definitions also. First, I'm going to tell you why your GAAP income, GAAP, I mean to say accounting income, it could be different than taxable income. Taxable income, it's a which is adjusted as per tax law. So I'm using two words here. I'm using first word what? GAAP income. GAAP income, it's a it is the profit under financial accounting. And then I'm saying taxable income. Taxable income, it's a this is the income which is adjusted as per what? tax law. And there are differences under accounting rules and tax rules. I'm saying main statement. There are differences between accounting rules and tax rules, and those differences can be categorized as permanent difference between tax and accounting, and those differences can be categorized as what? Temporary differences between tax and accounting. Let's understand the first definition. What are the permanent differences and what are the temporary differences? And please fix in your mind, deferred tax asset or deferred tax liability. It will always arise due to which difference? Due to temporary difference, not due to the permanent difference. Deferred tax asset or liability always will arise due to temporary differences between tax and accounting rules, but not due to the permanent differences. First, let's understand. Please need concentration. Literally, I'm repeating again and again because I want you to understand. Now, the point is, what is the difference? What is the meaning of temporary difference? And what is the meaning of permanent difference? So let me give you example here. Let's assume here, guys, you are not going to be a taxable person. You are going to be accountant here. Okay. So please remember here, guys, I'm explaining temporary difference. For example, this is GAAP record. GAAP record mean to say accounting. And this is what? Tax records. Tax mean to say taxable income, for example, which is adjusted as per what? Tax law. So what is the temporary difference? Temporary differences are also called timings differences. What? Timing differences. What it means? It means, for example, if, for example, there is a expense related item, let's assume, maybe if we are showing here in accounting, okay, we will also show in tax law, but timing could be different. Maybe here expense I'm showing in this year, there I'll show expense in the next year, or maybe there I'm showing expense in this year, but in accounting this expense will be shown in the next year, but it will be shown in both books of records, but time is the difference. That is called what? Temporary difference. What I said, for example, if there is any expense, it will be recorded in accounting also, it will be recorded in tax also, but timings could be the different, year could be the different. That I'll give you a number of examples, don't worry. Just we stick with this definition first. And same, there could be items relevant to what? Revenue. This revenue will be shown under GAAP also. This revenue will be shown under tax law also, but time is the difference here. Maybe in GAAP you will show in this year, in tax you will show in the next year. Or maybe in tax you are showing in this year and in GAAP you will show in the next year, but it will be shown, but just the time is the difference. This is called which difference? Temporary differences. It means it will come under both record. It will come under both record, but timing could be the difference. Now, this is what is the definition of temporary. Now, what is the permanent difference? Permanent difference. Please remember, permanent differences are those differences which, if it is recorded in GAAP, it will never be recorded in tax law. Never. Or if it is recorded in tax law, it will never be recorded under GAAP. If this is the scenario, that is called what? Permanent difference. Can I I'm going to quote 2-3 examples. Listen me carefully. First example I'm going to quote for permanent, then I'll tell you in more detail, don't worry. For example, fine. You paid fine, maybe traffic fine, or maybe anything else. You paid fine. It is fine and penalties. Fine, we record expense. Where we record expense? In the income statement. But when you submit this record to the tax authority, they are saying, what, you paid fine? Okay, so you want to claim as expense? No, it is not your expense. We don't accept it. It is your negligence. It is not your trade related expense. So what they will do, they will say, okay, remove this expense from the records. So it means it is a temporary or permanent difference because it is shown in the income statement, but it will never be reflected in the tax records. It is permanent difference. And due to permanent difference, deferred tax assets or liability will not arise. Another example, I can give you example. For example, you are earning interest on municipality bond, the bonds which are issued by government. We record whenever we receive interest, let's say you invested in the bonds as a company, you are receiving interest. So you will show income happily here in the gap. Yes, it is my income. But tax authority would say, oh, sorry, we don't take this as an income. It is exempt from tax. It means it is recorded here, but this income will never be recorded under tax rules. Is it permanent difference or temporary difference? Permanent difference. Understood? Now I'm going to give you another example for temporary differences. Then I'll give you number of examples. Okay. So temporary is what? It will be recorded under both records, but timing is the difference. For example, let's assume depreciation. There are two types of depreciation. One is depreciation under accounting, one depreciation is under tax. The depreciation which we calculate under tax, usually it is called capital allowance. Because here we follow tax rules to calculate depreciation. But under accounting, we follow accountant's estimates to calculate the depreciation. Now I'm asking you the question. You would just give me the answer. Okay. Tell me, this is one thing is common. Even you are using accounting records or tax records, asset will be depreciated 100%. Asset will be depreciated 100%. But maybe here you are depreciating less year by year, and here you are depreciating more. But it will be depreciated. For example, here you are depreciating with the rate of 20%, and here you are depreciating with the rate of 50%. But ultimately, it will be depreciated 100% here, and it will be depreciated 100% there also over the certain period of time. It means depreciation expense will be there, but timing is the difference. So this is called which difference now? Temporary difference. You understood? Right or wrong? For example, another example I'm giving you. Another example. Let's assume you made a credit sale. What? Credit sale we record under accounting. Agreed or not? Right or wrong? But for example, you made a credit sale in this year, but you didn't receive any cash. But you recorded this as a sale where in the accounting. But when you will take this record to the tax authorities, so they will say, have you received the cash? We would say, no, sir, not yet. They would say, okay, so we don't accept as a income. Once you will receive the cash, that time we can accept as a income. So this is now which difference? Temporary, it means sales will be reflected under both records. But in accounting, it is reflected in this year on accrual basis. But in tax, it will be reflected on cash basis. So this is which difference? Temporary difference. I can quote couple of examples. For example, warranty cost. Warranty expense. Usually under accounting, we record based on what? Accrual basis. For example, what is the accrual basis? I'll say this way. For example, I made a sale of $100,000 and my estimate that I will pay warranty expense or cost, okay, to the customers maybe $20,000. This is my estimate. Based on estimate, what I will do? When I will book the sale, immediately I will book the warranty expense, even it is not yet paid. It means warranty expense is recorded where in the income statement. But once you will go to the tax authorities will ask you one simple question. Have you paid this amount, this expense? You would say, no, sir, not yet. Maybe customer will come later. Then we will pay. They would say, okay, so for remove this expense, once you will pay, at that time you can claim that amount as a expense. It means expense, warranty expense will be there under accounting also and under tax also, but timing is different because under accounting you are booking on accrual basis, but in tax you can book only on cash basis. This is which difference? Temporary differences. I hope so you understood, right? Can you give me the statement of what statement I said? I said whenever you calculate taxable income, you always need what? Pre-tax accounting income, profit before tax. Then that profit you adjust for permanent and temporary difference. Permanent differences are which differences? If it is recorded in accounting, it will never be recorded in tax. If it is recorded in tax, it will never be recorded in accounting. And what is temporary differences? If it is recorded in accounting, it will be recorded in tax also, but timing could be the difference. Or if it is recorded in tax, it will be recorded in accounting also, but time could be the difference. That is what? Temporary. Deferred tax assets or liability will arise due to what? Temporary difference or permanent difference? Temporary differences. I didn't still explain the definition of deferred tax. Right? I'll explain it. So now let me give you example here. few examples just for permanent differences here. I by the way gave examples. It is just quoting one more time. I'm quoting it. For example, first of all, I told you these differences will be recorded only under one books, not under the second books. Right or wrong? If it is recorded under accounting, it will not be recorded under tax. If it is recorded under tax, it will never be recorded under accounting. Just giving you 3, 4 examples, try to understand. First, I'm going to talk about what? Income items. Which items? And these income items are included in the net income. It's accounting. It's included in accounting, but it will not be included under taxable. For example, first example is what? State or municipal bond interest, as I gave you example. That you have invested in the government bond, you received some interest. That interest you are showing as the income in your income statement, but tax authorities, they don't take it as a income. So you cannot record there. It means it is recorded under accounting, but it will never be recorded under tax. So this is what is permanent difference. Another example, proceed from life insurance of employees. Maybe some employees got injured. Now you are getting some claim from insurance companies. Right or wrong? Maybe that claim you can show as other income in your income statement, but tax authorities, they don't accept that proceed as a income. So this is what, which item it is? Income item. Again, it will be recorded in accounting, but it won't be recorded in the tax. Understood? These two examples are for what? Income items. Let's have a look. Let's have a look for maybe expenses side. Okay, expenses side. So whenever, for example, as I gave you example fines. Fines are always recorded as expense where? Fines are recorded expense where, guys? Always under accounting, but tax authorities, they don't accept it. There are plenty of examples. Right or wrong? Maybe, for example, you have paid premium premium on insurance, and you are saying, oh, it is my expense. Tax authority says, no, sorry, we don't take it as a expense. Right or wrong? So this is what, like, there are a couple of items out there. Is that clear? So you understood permanent differences versus what? Temporary differences. So now, guys, here we go. I'm going to explain two more terminologies, and then we are moving to the deferred tax definition. Let's have a look first. What is deferred tax now? Now I'm explaining what is deferred tax. Can you tell me one thing now? What is current year tax? That's current year tax expense is actual amount or estimated amount? First, give me the answer. It is you are estimating, guys. Actual amount you would come to know only when tax authorities will send you email. This is your tax due. Right or wrong? It is your estimated amount. By the way, here we go. Let's have a look. So, what is deferred tax definition now? Deferred tax, I'm telling you. Please, please, please. Deferred tax mean to say you have recorded certain transactions in this year or in previous year. What statement I said? You have recorded certain transactions in the current year or in the past year. But due to these transactions, you would pay tax in the future or you would receive tax in the future due to these transactions. So that is why it is called deferred tax. The tax which is deferred so far. Like these transactions are recorded today, but due to these transactions, either you would pay tax in the future or you would receive tax in the future. That's why it's called deferred. Deferred, you are delaying something, right? So deferred tax. This is the definition. Deferred tax is what? It is the estimated. Again, it's not actual, guys. It is estimated. Estimated future tax consequences. What is the word? Estimated future tax consequences means either you would pay in the future or you would receive. Okay, I'm asking question. If you would pay in the future, should it be your asset or liability? Liability. If you would receive in the future, asset due to these transactions. Right or wrong? So this is what they say. The deferred tax is the estimated future tax consequences of transaction or event in the financial statement of current or previous period. Like in simple words, these are those transactions which we have recorded in the current years or in the past years. But due to these transactions, either you would pay tax in the future or you would receive tax in the future. Now, one more key point here, because this topic is relevant to accounting. I'm not teaching you tax law. Right or wrong? So here we have one more point, point number 2, that is also need to understand. It means I'm talking about deferred tax. Deferred tax is the only accounting entry, because as accountant we want to show our records. Even some amounts are estimated, but close to the accurate value, right? So that is why this is what only the accounting entry. It will affect only tax expense where in the income statement. Please remember, this accounting entry is not going to affect your actual tax which you are going to pay to the tax authorities. The tax authorities will tell you how much actually you have to pay. Usually what we do, if your accounting year ends maybe by 31st December, we have 2-3 months to file tax returns, or maybe we have a 9 months sometime to file tax returns. It means you would come to know after 9 months or after a couple of months what actual tax you have to pay. But accounting records you are preparing by the end of year. That is why it is just accounting entry. It has nothing to pay, nothing to do with any actual amount of tax. Understood? You understood? Because actual amount of tax authorities will let you know how much you have to pay. Is that clear? Now here we go. This is now I explained what is deferred tax. Can you explain the deferred tax, right? If someone will ask you what is deferred tax, you would say it is a future tax consequences of the transaction which you have already recorded in your current years or past years. Because due to these transactions, either you may pay tax in the future. If you may pay tax in the future, that should be your deferred tax liability. Or if you would receive tax in the future, that should be your deferred tax asset. Understood? Now we have 2 more terminologies and then we are into the calculations. Don't worry. Once I teach you calculation, you will say, oh, it was easy. But at starting point, it is very hard to convey actually what is the real concept. Okay. So here we go. So we have 2 more terminologies. We know accounting, we always do what on accrual basis. And taxable profit always is calculated on what? Cash basis. And I told you why accounting profit is different than taxable profit. There are 2 reasons: temporary or permanent. I told you, right? Deferred tax liability asset will arise due to which difference? Simple question I'm asking. Deferred tax asset or liability will arise due to which differences? Temporary or permanent? Temporary. Don't say permanent. Right? Okay, now we have here permanent difference also explained here. Now we have here 2 more terminologies here which we need to understand. These 2 words I'm going to explain. One word is called taxable temporary differences. What? And second is called what? Deductible temporary differences. 2 more words I'm trying to fit in your memory. What is the word? Taxable temporary difference. And second word is what? Deductible temporary difference. So what it means, let's understand the meaning so far only. If let's assume they are saying in the question, they will, for example, they will ask you taxable temporary difference results in what? Taxable temporary difference would result in always what? Deferred tax liability, because it is taxable temporary differences on which you have to pay tax. It means any difference. Now please understand, any difference which will lead to deferred tax liability, that difference would be known as what? Taxable temporary differences. Don't use word only temporary difference. The proper word is any difference due to which your liability will arise. That is called what? Taxable temporary difference. And any difference due to that deferred tax asset will arise. That is called what? Deductible temporary differences. Can I ask question here? I'm asking question. Deductible temporary differences would result in what? Option A, deferred tax liability. Option B, deferred tax asset. Deferred tax asset. Taxable temporary differences would result in what? Option A, deferred tax asset. Deferred tax liability. Deferred tax liability. Just 2 terminologies. It has nothing to do with the topic, but just we need to understand that wording, because sometimes questions are on wording also. Otherwise, once I teach you calculation, so I would use these words also. In liability, I would always say it's taxable temporary differences. In asset, I would always say it is deductible temporary differences. Understood? How you would define taxable? Because due to this difference, you would pay tax. That's why it's called taxable temporary difference. And what does mean by deductible temporary difference? Because due to this difference, you would be refunded or you would get some benefits on the tax. That is called what? Deductible. It will deduct, it will reduce your tax expense and it will increase your tax expense, and this will decrease your tax. Understood? Now here we go, guys. Please remember, there are now we are into calculation. Literally, if you will give me 30 more minutes by active mind, so you will not forget this topic. So we have here different approaches are there to calculate deferred tax assets and deferred tax liability. One approach is called what? Asset liability approach, which is very difficult to word being a student. Which approach I said? Asset and liability approach. And in this approach, what you are going to do, I'm just going to show you formula only. Then I'll work with the calculation. Formula is what? You will always take what? Tax basis. Tax basis means it, what is the value of asset or liability as per tax law? What should be the value of asset or liability as per tax law? That is called what? Tax basis. From there, you will deduct what? Carrying amount. Carrying amount means say what is the value of that asset or liability as per accounting law. Here, what is the value of the asset or liability as per tax law? What is the value of asset or liability as per accounting law? Just take the difference and multiply with the tax rate. You will get what? Deferred tax assets are liability. How would you know? Please remember the formula first. Tax basis minus accounting basis equals difference times what? Tax rate. If answer is positive, so that answer is called deferred tax asset. If answer is negative, we would say deferred tax liability. Don't worry, I'll work. But to understand the concept of the deferred tax, I'll follow this formula also. So I would use this format to deal with it. Now, please, I need concentration. First, we are going to talk about what? Deferred tax liability. Then I'll talk about deferred tax asset. Ready? So here we go. Please, this is the statement you have to memorize very strongly. If income under GAAP is accounting income. Accounting income. So whatever profit is showing under accounting records. If it is greater than which income? Taxable income. Taxable income means which is showing as per tax records. If GAAP income is more than taxable income. So please remember here, let's assume value here. Let's assume GAAP income tax. Let's assume under GAAP income is $100, and under tax income is 100 and for example $90. Now I'm asking for simple question here. Need concentration here. If I would ask you on which amount you would pay actual tax, you would pay on 100 or you would pay on 90 actual tax? You would pay on 90, right or wrong? If you are comparing left in tax rate, it's 40%. Here tax, as per accounting rate, tax should be 40. Here, if you will multiply 40%, I'm assuming, let's assume value is 38. I'm assuming. I'm asking again one more time question because this connection is very important. You have a tax as per GAAP, how much? $40. And tax as per what? Tax rule, you have how much? 38. You are paying, actually paying, you are paying less or more. Actually, you are paying less or more. Actually, you are paying actually this is what you would pay, which is as per tax record, right or wrong? Actually, you are paying less. If today actually you are paying less, today, tomorrow you would pay more. Make connection. If today you are paying less, tomorrow you would pay more. If tomorrow you would pay more, today it should be your liability or not? Because tomorrow you would pay more. You will pay more value, more tax. It means today you have to book that liability. So that's why it's written here, whenever income under gap is, I will not leave this point, I'm telling you, until you are clear. If income under gap, you have to see, income under gap is more or less. Oh, it is more. It means the difference is called what? Future taxable amounts. Future are taxable temporary differences. Taxable temporary differences. Taxable. So it will result in what? Deferred tax liability. Just remember the question. What is the question? If gap income is greater than taxable income, this is called what? Future taxable amount. Difference is called future taxable amount. And this would result in what? Deferred tax liability. Fix in your mind. Can I say I'm asking you the question? You would tell me what it is. I'm saying taxable income is less than gap income. I'm saying same thing. I'm saying taxable income is less than gap income. Or gap income is more than taxable income. It is same thing, right? Right or wrong? This would result in what? Future taxable amount, and what will arise? Deferred tax liability. And this deferred tax liability, which balance? Which balance? Closing balance, because opening will be given. Closing you have to work. And then you can calculate net increase or decrease. Now, open your mind and think. Now, open your mind and think. What we said? We said gap income is higher than what? Income under tax. Is what I said right here. Right or wrong? Gap income is higher than what? Taxable income. Right or wrong? Now you have to think. Please need concentration. You have to think why gap income is higher. Why? So in question, he may give you data about what? Revenues or gains, or he may give you data about what? Expenses or losses. Need concentration here. Gap income is higher than taxable income. How gap income could be higher? If data is about what? If data is about revenue, it means you have written more revenue under accounting and less revenue under tax. Less or even no revenue under tax. That is why gap income is higher. Understood? Or if data is relevant to expense, how gap income could be higher? Maybe here you have recorded lower expense. Lower expense means a higher income. Agreed or not? Maybe under accounting you have not recorded expense, or maybe you have recorded less amount of expense. But under tax you have recorded higher amount of expense. So this scenario could also result under what? Gap income could be higher than taxable income. Can I ask question here? I'm asking now. Please. Asking when deferred tax liability will arise. First question: whenever gap income is more than taxable income. Now, how it is possible that gap income is higher? If data is relevant to revenue, what happened? You recorded a higher amount of revenue under gap. You have recorded less or no amount of revenue under tax in this year. So that this could result in higher income of gap as compared to taxable income. Or if data is relevant to expense, how gap income could be higher? Because you have recorded less expense or no expense, and here you have recorded higher expense. Higher expense means a less income, right? So this can also result. It means in your exam questions, he would give you either data about what? Revenue, or he would give you data what? Expense. And this should happen. This should happen to get what? Deferred tax liability. What should happen? This formula you have to memorize. Understood? But the point is that how you would calculate deferred tax liability, because you are working here deferred tax liability. What you will do? So simply you will take the difference. For example, if item is relevant to revenue, I'll write revenue here. Write revenue here, take the difference. And that difference multiply with what? With the tax rate. That is called what? Deferred tax liability. Just take the difference. Or if item is relevant to expenses, I'll take the expense here, I'll take the difference of expense and simply I'll multiply with what? With the tax rate. This will give you what? Deferred tax liability. In which year? In the current year. In the current year. Or I can apply this formula if I'm applying asset liability approach. Tax basis minus accounting basis equal to temporary difference multiplied by tax rate. If answer is positive, it is asset. By the way, answer will be negative to get the deferred tax liability. But I would suggest this way to solve questions. It will make your life more easy. Let's do the one question now. I'm going to show you the question and open your mind, please. Huh? So here we go. So here we are going to read a question here. Whatever calculation you are going to do, please, you are doing the calculation in which year? In the current year. This will make your life easy. Fix it in your mind. In the current year, you have to look where income is recorded higher, where income is recorded lower, or where expense is recorded higher, where expense is recorded lower, only in the current year. Take the difference, multiply with the tax rate, you will get deferred tax liability. Understood? Ready? Now I'm asking you question. I'm first reading the question with you, and we will do it. This thing, for example, in year one, Luxor Corporation. Luxor Corporation recognizes how much? 800,000 of sales on credit. Tell me, credit sale, where it is recorded, in accounting or in tax? Accounting. Accounting. Credit sale is recorded in accounting. Tax authority is usually the accept when you will receive the cash. Okay, it means in accounting what happened. So I'm just writing here income under GAAP and income under tax. So because you have to focus only the current year, what happened in the current year? In current year, there is a credit sale of how much? 800,000. I just wrote 800,000 under accounting. Right? Now I'm reading the question. Continue with the question. Now what? The cash will be collected in year, not in year one. In year one, you had a sale, but cash will be collected in year 2 through 5. Means you will get collect cash in year 2, 3, 4, and 5. And what are the amounts? In year 2, you will receive how much? 300,000. In year 3, you will receive how much? 200,000. In year 4, 200,000. In year 5, 100,000. This is how it will become what? Total how much? 800,000. Stop it here, and I'm assuming our tax rate is how much? 40%. This is what I want information only. And I have to work current year. Current year is what? Year one. Current year is what? Year one. Today, what happened? In this year, what happened? In this year, I have recorded under accounting how much income? 800,000. And in this year, I have not recorded an income under tax. Why I have not recorded? Because cash is collected from year 2 to onward. It means in this year, what happened? Under this data is relevant to revenue or expense. This was revenue. So it means under GAAP income is higher and under tax income is zero. It means what is the result? Result is what? Income under GAAP is higher than income under tax. Whenever this scenario will arise, whenever GAAP income is more, so what will arise? Deferred tax liability will arise. Now please focus with me here. How you will get deferred tax liability? Simply I'll take the difference of these two values. What's the difference? 800 comes. Multiply, what is the tax rate? 40%. And this will give you what? 320,000. This is called your what? Deferred tax liability. How it is? Why it's liability? Because GAAP income is higher. Right? What is your deferred tax liability value here in the year one? 320,000, right? Now see, we can cross check this. Okay, you can just solve up to here and you can get the answer of your question in your exam. That's it. But I'm just proving now. You need to do this only in your exam. Take the difference in the current year, multiply by tax rate, and you will get deferred tax liability. You will get the answer on your calculator. That's it. Question will be solved. But I'm just proving. Now tell me, now let's assume this is tax record for year 2 to 5. And this is what? Accounting record for year 2 to 5. Here there will be no sale, right? Because you have all recorded all sale in year 1. But here sale will be recorded and tax recorded because you collected cash how much? 300,000 in year 2, it's given in the question. In year 3, you received how much? 200,000. In year 4, you will receive how much? 200. In year 5, you will receive how much? 100,000. This is what? 800,000 you will receive from year 2 to 5. Total how much you will receive? And at that time, you will pay tax with the rate of 40%. So see, what is the answer? 320,000, which is the same here, right? Do you want to follow this way or you want to follow shortcut way? Shortcut way. do only calculation in which year? In the current year. Because we are not going to solve essay question, trust me, in your exam at this topic. MCQs will be there if any one or two. Clear? Is that clear? We can look at here because if you're following assets liability approach, again, I'm just sharing, but you need to remember only the first thing which I told you. Understood? I'm sharing, for example, we can take tax base and accounting base. Tax base is what? Due to credit sale, what will arise in the current year? Receivable will arise or not? Due to credit sale in the current year, receivable will arise or not? How much is the receivable in the year one? Because you will receive cash in year 2, 3, 4. In accounting, you have a receivable of how much? You have a receivable of 800,000. In tax, we do not book any kind of receivable. That will be what? Zero. It means this is your tax base. This is your accounting base. So tax base minus accounting base, you got negative 800,000. Multiply by 40%. So you will get what? 320,000 negative value. If it is negative, it is always called deferred tax liability. But I won't recommend this. I told you just follow the first thing. Focus on expense item and income item. But remember this equation only maybe an exam question he may give you straight away tax base of certain assets and accounting base of certain assets. A tax base of certain liabilities and accounting base of certain liability, then you should be able to apply this formula. What is the formula? Tax base minus accounting base equals difference times tax rate. If answer is negative, it is deferred tax liability. If answer is positive, it is deferred tax. Yes. I'm going to show you one more question for deferred tax liability again. For what? Deferred tax liability. Because liability question, then I tell you asset is totally opposite. We have another example. For example, this thing on January 1, year 1. This is year 1, right? I'm just writing year 1. What happened under year 1? I have to look only. Okay, this I wrote here. What happened under GAAP? What happened under tax? I just made two columns. Let's think on January 1, year 1, Luxor buys a piece of equipment for $100,000. It will be depreciated over its what? 5 years useful life on straight line basis for financial reporting. Now tell me if this asset you are depreciating in accounting, what is the depreciation rate? You have to depreciate over how many years? 5 years. It means what you will do in accounting? 100,000 divided by 5 years per year. Depreciation is how much? 20. So depreciation is expense or income. Depreciation is your expense. And in accounting expense in the first year, because you have to work on only in current year. And current year expense is how much? 20,000. I have to look what is the tax rule for accounting. And they're saying the following accelerated percentages will be used for tax purpose. And what is the first percentage is given? 59. It means in the first year, as per tax rule, it should be depreciated by 59%. In second year, it will be depreciated by 16.5, then 9.5, then 8, then 7. But in accounting, every year it will be depreciated by 20%. Right or wrong? So I am doing in the current year calculation. Oh, okay, in the current year, if I'm calculating tax depreciation, what I'll do? I'll take cost of asset, multiply by what? 59% because it's the year 1 depreciation rate. So I got a depreciation expense, how much? 59,000. Agreed? In accounting, how much depreciation you have written? Okay, and in tax, how much depreciation you have written? Where expense is higher? Tax. It means if expense is higher, income will be lower. So what scenario is created? GAAP income is higher than taxable. Understood or no? Why GAAP is income is higher? Because expense is less there. Taxation is expense now. If expense is less under GAAP, it means income is higher. And if expense is more under tax, it means income is lower. So it means scenario is created. GAAP income is higher than taxable income. Now you want to know what is the deferred tax liability value. What you will do, just take the difference. Difference how much? 39,000 multiplied by 40%, you will get deferred tax liability of 15,600. Do you want to know? This is the answer. You got it in the first year. But if you want to know what will happen in year 2, 3, 4, and 5 onward. So now in the next year, what will happen, please? I'm just showing here. First, it's shown here. Yeah. In the next year, I'll come back then. This is year 2 now. Year 1, we already done. in year 2, in accounting, how much you will depreciate? Sorry, this is tax. This is tax percentages. And this is what? Accounting. Accounting percent every year you will take 20, 20, 20. But in tax, he told you in year 2 it will be 16.5, then 9.5, 8, and 7. Tell me where depreciation you are charging less and where you are charging more. You are charging less here, right? This is tax. Less depreciation means say in future. Now this is future. In future, what will happen? In future, what will happen? Less expense mean to say more income. That's why you will pay more tax now. That's why it was liability previously. Because you have to pay tax in future. Right? In future, not in current year. In future, what will happen? Your gap income will be less or more, will be less, and tax income will be more. Why? Because in future, this is what I said, correct or not? Because these tax rates are for what? These tax rates are for these depreciation rates for tax. It means in future, under tax depreciation will be less, agreed, and here depreciation will be more by 20% here, percentage are less. If this is expense, so what will be the income? If expense is more, income will be lower, and here income will be higher. Now tell me, because initially it was your liability, now this liability will reverse over the years. So just take the differences, what you will do guys here, because this liability you would pay in future, right or wrong? That's why it's here your liability today, because you would pay in future. So what you will do, you will simply take the difference of percentages and multiply with the 100,000. So this will give you how much that excess, sorry, how much lower depreciation you are calculating where in the tax. This is lower depreciation in the tax, it will be there. You understood what I said? Guys, just make a connection here. These are tax percentages, agreed? These are which percentages? Accounting percentages. Where expense is less? In tax expenses is less. It means income will be more. It means with this value, taxable income will be more in future. Agreed or not? And just we will add all these income, make the summation, multiply with the tax rate. This will give you same value, 15,600, which you have calculated this way initially. Initially, in the current year, you calculated this, right? Because in current year, in the current year, you have calculated this 15,600, right? Because in the current year, expense under accounting was how much? 20, and expense under tax was how much? 59, right or wrong? So gap income was higher, right? By how much? Take difference, 39,000 multiplied by 15,000, multiplied by 40%, you got 15,600. This 39,000 actually it will reverse in the future, Look at here, if you will take the difference, this is also 39,000. Right or wrong? As I told you, if you will look over the future years, you may confuse it. So you have to solve question. But I told everything. But you have to solve question, just work within the current year. And current year rule is what? I told you simply this is the rule in the current year. What is the rule in the current year? In the current year, you will always follow this rule. If gap income is higher than taxable income, so what will happen? Deferred tax liability will arise, and gap income could be higher due to revenue or gains, or due to expenses or losses. Understood? Only have to do calculation which year? Only in the current year. You can do it, right? So if same example, I'm just saying again one more time. This depreciation example, what happened? What happened in current year? In current year, if you are confused with the future years, future year, just focus on the current year. In current year, what happened? You have recorded depreciation of 20,000 in accounting, and you have recorded 59,000 depreciation in tax. It's expense or income? Tell me. Expense. Where expense is higher? Under income tax law. It means expense is higher, means income will be lower, and here expense is lower, means income will be higher. It means there is created gap income is higher than taxable income, right or wrong? So it means what will arise? Deferred tax liability will arise. How it will arise? Just take the difference, which is 39,000 multiplied by 40%, you will get 15,600. That's it. This is your deferred tax liability in the current year. That's it. But in future, this liability will be reversed, right? You will settle. So that was the next one which I was telling you. If you are confused with that, settle.
In the future, I will refund, not pay.
You would pay. Why you will refund? Liability you will settle, or you will take more money from them.
This will be my payment every year.
This is total payment, but this payment will be splitted over the years.
Because if we can compare as with this equation for the second year.
Second year, you would just, this is your total liability, 15,600. Just hold, let me clear it, because what is your total liability? 15,600. In second year, what will happen? In second year, you will do only this calculation. Only this calculation. In second year, your gap income, your taxable income will be higher. You will pay multiply tax rate, this much liability you will settle. Again, third year, multiply by tax rate, this liability will be settled. Again, the third year, multiply by 40%, this liability will be settled. Okay, this is how liability will be settled. Understood? This will be settled over the number of years. Is that clear? Okay, so same year, if you have a deferred tax asset, which we will study later, so every year you will have a refund for that. But liability, you would have a payment for that. Understood? Clear? Now, but here I have said is clear, right? Clear, right? Now I'm going to tell you about what deferred tax asset. Okay, here one point I skipped here. What was your total deferred tax liability you have calculated? Tell me. Deferred tax liability was how much? 15,000. Not participating. 15,600. Now you can apply asset liability approach also. Tax base, how you will get tax base? Take the cost of asset, which was how much? 100,000, and minus first year depreciation under tax was how much? 59,000. This is tax base, right? And accounting base, how much? Cost of the asset minus accounting depreciation 20,000. You will get what? Accounting base. Now apply the formula. Tax base is how much? 41,000. Carrying amount, accounting base is how much? 80,000. You will get the here difference. Difference would be how much? Difference would be 39,000 negative. Multiply by 40%. Again, you are getting deferred tax liability of 15,600. This liability you calculated which year? I'm asking question. Current year. But this liability will be settled in future year. Year 2, 3, 4, and I have said this clear now, right? But in your exam, you will ask you question what happened in the current year. Okay, so for that small equation you can apply and you can answer the question. Now I'm going to talk about deferred tax asset. So deferred tax asset is totally opposite to the deferred tax liability. So what will happen here? Here gap income will be less or greater?
Less.
Previous it was greater. Now it would be less. Gap income is less than taxable income. For example, let me create scenario. Let's say this is gap, means accounting. This is what taxable income. Under accounting, income is 50, tax income is 90. You will pay actual tax on this value, right? Right or wrong? So you are paying today, you are paying higher tax if you are comparing both amounts. You are paying higher or lower? You are paying higher. In future, you will be refunded for that. That is what's called deferred tax asset. Understood? Because in future, you would be refunded for that whatever extra payment you are making today due to temporary differences, not due to permanent. Okay, so what the scenario here? Here gap income would be less than taxable income, and the difference is called what? Deductible differences. Which one? Future deductible differences. And deductible difference, what would result? It would result in deferred tax. This is important. Second important statement. Gap income is less. Then say I'm saying correct or not? I'm saying taxable income is higher, gap income is lower. It is same thing. Gap income is lower than taxable income, or taxable income is higher than gap income. It's the same thing, right? I'm saying in two different ways. And what would result? It would result in deferred tax asset. And how you will calculate deferred tax asset? Now you have to remember here how it is possible that gap income is lower and tax income is higher. Again, there are 2 points. Either data will be relevant to revenue or about expenses. Why gap income is lower? Maybe here, if it is revenue, you are recording less revenue or no revenue, but here you are recording higher revenue, if this would result, so automatically this scenario will be there. Gap income will be less than taxable income. Or if data is relevant to what? If data is relevant to expenses, so what will happen? Expense would be higher here under gap and expense would be lower or no expense under tax. So if higher expense means a lower income, right? And lower expense means to say higher income. Right or wrong? Again, this scenario will arise. What is the scenario? Gap income is less than taxable income, and what will arise? Deferred tax asset. Right? And how you will calculate deferred tax asset? Just take the difference of these two values and multiply by what? Tax rate. You will get deferred tax asset. This deferred tax asset you will book in the current year. It will be refunded over the future years. Right or wrong? Right? So how would you do the calculation now? Let's have a look. And we can do that this asset liability approach also, how we will take tax base minus what? Carrying value of asset or liability multiply by equals what? Temporary difference multiply by tax rate. If answer is positive, it will be deferred tax asset. If it is negative, it will be deferred tax liability. Understood? Clear? Same is this is the same equation. Positive asset, negative liability. Let's do the question now. We have to check first when you read the question. Is it expense or revenue related item? And then see where expense or revenue have recorded higher, where you have recorded lower, where income is higher, where income is lower. Is it deferred tax asset? Is it deferred tax liability? Right? So here we go now. We have a question here. So forget about everything. Just look at the question and apply the logic. They are saying on January 1, year 1. This is year 1 again. Current year. I'll do the calculation for current year. This is what income under gap. This is income under tax. Now, they're saying S company sold 4-year subscription to industry journal for how much? 40,000 in cash. Right? In its financial statement. You sold subscription. That means it's a revenue for you, right? You sold it now, it's a revenue. They're saying you sold it for cash, how much? 40,000. Okay, tax in accounting, what you will do? Tell me in accounting. You would record this. This is now tricky. Here, you accounting, you should also know. Whenever you received advance payment, it is whole amount your revenue. No, you have to provide services over 4 years. In the first year, how much revenue you can book? Because if this subscription is for 4 years, in the first year, you can book revenue only if you know proper accounting is what? When you receive cash, you will debit cash, credit liability, right? Unearned revenue by 40,000. And at the end of the first year, because the subscription is for 4 years, when you received advance, you book the liability, unearned revenue. But at the end of the first year, because once first year will expire, you will debit unearned liability and credit what? Revenue by how much? 10,000. Because it is for 4 years. Second year, you will also repeat this entry. Third year, you will also repeat this entry. Fourth year, you will also repeat this entry. But in accounting, this is accounting. In first year, how much revenue you have recorded? Tell me. 10,000. That's what's written. 10,000. It's revenue. In accounting, it is how much is recorded? 10,000. And tax is cash basis, right? Tax. They said you received 40. Yeah, great. It is your income. So we'll write 40,000 under tax. Now tell me what happened. Under tax, we record higher income. And under gap, we record lower income. And what would be the result? Gap income would be less than what? Taxable income, right? And how much is the difference? 30,000. Multiply by, if let's say it is 40% the current year, this will give you deferred tax asset. Understood? Do you want me to see this asset you will book in current year? But in year 2, 3, 4, this asset will be refunded. Now tell me in year 2, 3, 4, what will happen? Just asking question. In year 2, would you record any income in tax? Because you have already recorded 40,000, but you will record income under gap on it, under tax it will be 0. Right or wrong? Multiply by, for example, 40% tax rate. This will be the refunded value in the second year. In third year, what will happen again? You recorded under gap 10,000, but under tax it will be 0 again. But you got 10,000 multiplied by 40%. This will be refunded. Again in third year, 10,000 here under gap, the tax 0 times 40%, you will be refunded. And total refund value, if tax rate is same 40%, Total refunded value will be, total refunded value will be how much? 12,000. 12,000. Understood? And total refunded value will be 12, which was value in today. Here. We got it right? Can you tell me here asset liability approach also? Tell me in accounting, your total liability you have booked by 40,000. In the first year, you have debited liability by 10. So remaining how much? 30. And in tax, it will become what? In tax, it is 0, right or wrong? Maybe it is solved here. You can see here. In tax, it is 0. Tax base is 0. In accounting, you have a liability of 30. So tax base minus accounting value, it will give you 30,000 negative, multiple 40%. So this will give you 12,000. Sorry, it will give you 12,000 as a deferred tax assets. So first you have to deduct, actually this is the accounting value here. This is, what was the accounting value? How much is the liability value? Accounting value is 30,000. Tax value is how much? 0. Apply the formula. Tax base is 0. Accounting value is how much? No, accounting value is 30,000, nah? Because 40,000 was total liability, 10,000 you have taken to the revenue. Remaining is 30,000. This is the carrying value at the end of the year. So this will give you what? 30,000 multiplied by tax rate. This will give you deferred tax asset. But in deferred tax asset, I guess you should change this value. Carrying value you should keep first, then tax base. Right or wrong? Otherwise, this value will be negative, right? Negative means a liability. In tax, there is small mistake. This value should be here and carrying value should bring here. Carrying value minus tax base. In liability, what was the formula? Tax base minus carrying value. Here, what formula you will follow? Carrying value minus tax base. Understood? If it is positive, it is assets. Clear? Understood? Now I'm going to show you one more question here. Here you have to look again. You have to read. First, you have to identify, is this question is about revenue or about expense? And then see what happened under tax in the current year and what happened under the accounting in the current year, and see how much is the difference. Is it liability or is it asset? Clear? Understood? Now I'm asking one question first here. Give me the answer. Whatever here deferred tax asset liabilities we have calculated, these were opening balances or closing balances? Closing. These balances you should compare with the opening. Then you will get increase or decrease. Then you will pass entries to get the income tax expense. Clear? These are closing. I'll repeat it again. Don't worry. Let me do this. In year one, what happened here, guys? In year one, Luxor accrued how much? 70,000 of warranty cost for financial reporting purpose. It means you have recorded expense in accounting how much? You have recorded expense how much? 70,000 under GAAP. This is what is written accrued. Accrued means accrual basis, not yet paid. This is expense. This is what? Expense. You have recorded under GAAP how much? 70,000. Then they're saying from the past experience, it expect the cost to be incurred in year 2, not in current year. Through 5 as follow. In year 2, you would pay maybe 5,000. 3, you would pay 15. 4, you would pay 40. You would pay 10. It means in the current year, you are not paying anything under tax. It will be 0, right? It will be paid from year 2 to 5. Now tell me how much expense you have recorded under accounting. 70. How much you have recorded in tax? 0. So what's the difference? 70. Tell me, this is expense. Higher expense mean to say lower income. It means GAAP income is lower. So deferred tax asset will arise. Right or wrong? So what you will do, just take the difference, which is 70,000 multiplied by 40%. This will give you deferred tax asset. This asset will be refunded in the future. In future years, what will happen? It's written here. In future year. Future year is year 2. Previous calculation was for year 1. Year 2. In year 2, what will happen? There will be no expense under accounting. Only expense will be under tax. Right or wrong? Your taxable income will reduce by 5,000 here, by 15,000, by 40,000, by 10,000, and multiply by tax rate, tax rate. So this will give you what? Refunds for you in year 2, 3, 4, and 5. If the tax rates are same, so the refund will be 28,000 over years. Understood? Clear? Now just finally we will, okay, carrying value, we can also do carrying value. Because this was the, under tax, what happened? Tax basis of warranty liability. Under tax, there was no liability. We don't book accrual basis liability, right? But under warranty liability, what was the liability value, how much? Because when you record warranty expense, you know what entry you pass, you record warranty expense to warranty liability. So liability was how much? 70,000. This has accrued, right? This has accrued means you have booked in accounting, he told you in the question. Means the liability is there 70,000. So 0 minus 70 times 40%, so 28,000 would be the deferred tax asset. This is the asset liability approach. But easy approach is what? Work with revenue, work with expenses. Clear, guys? And can you summarize now? Okay, what we will do whenever you calculate income tax expense. So how many items it has? It may have what? Current year tax. I told you current year tax, how you will take? Taxable income times tax rate. This will give you current year tax. And then you have to do what? Plus or minus. Okay, if you're dealing the deferred tax asset, if there is a decrease in deferred tax asset, that will be added. If there is an increase in deferred tax asset, that will be deducted. And if there's an increase in liability, will be added. Increase in deferred tax liability will be added. And decrease in deferred tax liability will be deducted. This will give you final tax expense for the income statement. And now I'm asking question, this is GAAP, this is tax law. If GAAP income is high, tax law. GAAP income is higher, what will rise? Deferred tax liability. But if GAAP income is less than tax, what will rise? Deferred tax asset. And you know, GAAP income could be more or less due to what? Due to item of revenue or expense. And you can create the scenario now, right? Is that clear? And deferred tax asset will rise due to permanent difference, temporary difference. Temporary. What is temporary difference? Timing difference. Right? It will be recorded under both brackets, but time is the difference. Understood? This is what all about deferred tax. It is enough at your level, more than enough. Okay, guys.